Hi, it's Helen Tarrant. Hi there, it's Helen Tarrant, and welcome to another episode of Commercial Property Roadshow. Today I'm actually to show you how you can get started in commercial property for $50,000. So $50,000 and the variety of choices you have. So the type of property you should be looking at, or the type of property you can get into, the type of deals, whether it's in regional or metro that you can buy. And don't forget, just because you've got $50,000, that shouldn't stop you from getting into commercial property. You can buy $150,000 compared to, maybe, to $200,000 compared to, if you had a larger deposit where you could buy $300,000 or $400,000. But, starting small should never stop anybody. And even if you're in the range of $150,000 to $200,000, doesn't mean you can't look at a property that's $200,000 and start negotiating down, because you never know. The vendor could change their mind in a second, and the vendor could have distress situation where they just need to sell. And $150,000 to $100,000 is a really liquid space to be in when you're buying something in your portfolio. And I'm an advocate that someone should always have something that's $150,000 to $200,000, because the moment you want to sell it, there's always going to be a buyer out there, because someone who can always afford it, someone who's starting out, which means that, if you're selling a $2 million property, it's much, much harder to sell than a $200,000 property, because, it's very accessible. And for most people, it's a no-brainer to just sort of have a step in and trial it out. So let me go to the whiteboard and let me show you what that works in terms of numbers so that you understand what your choices are. If you're buying a 10% yielding property, so say 10% yield, and you have $50,000 in deposit, if we're looking at leveraging that to, on a 70% LVR or 75% LVR, but let's just look at it at a 70% LVR, what that would be. It would be somewhere around, just working out the numbers here, it would be around 150K to maybe 170K in terms of an LVR. So, but if you're getting a 10% yield and you're buying $150,000 in a property, it means you're getting 15K net. So that's after all expenses, right? So your loan is most likely going to be somewhere around 150 for the loan. At the moment, it's going to be sitting around that 4% or a bit lower. So we know that your loan is going to be sitting somewhere about $4,000. So that equals to 4K. So your 15K minus 4K is going to be around $11,000 in positive cash flow for a property. Now, what does that property actually look like? This property is going to be in somewhere maybe like Blackwater. So that's, your regional Queensland, and very regional rural QLD. It might be a small shop in regional Victoria, and again, we're looking at very smaller shops, and or it could be in an area like regional New South Wales. So that could be what that property looks like. Now, obviously, this property has a few inherent things in there that may not be the best, because remember, it's high risk, because you're getting a high yield. So it equals high yield, which means that if your tenant was to vacate, there will be a longer. So what that actually means is it means longer vacancy period if tenant leaves. So what happens if we scale that back and we take a property that is going to be the same 50K, and this will be a bit hard to find, but let's say that you're buying 150K in terms of a property to 170K. That's a very, very small property, and you might buy it, a small office space in Sunshine Coast, Brisbane, or the Gold Coast, right? And these properties exist, or sometimes you buy them in Metro Melbourne, so along Secure Road. So they're very small premises, and sometimes they're somewhere between 50 square meters, right? And most of the time, if you want to get into the market with 150K to 170K, that's the type of property you'll be buying. There, at most, it's going to be a 7% yield. You'll find the tenants are maybe on rolling leases, and what that means is they're on shorter leases because they're going to be in a metro location, so they might be on 1 to 2 year leases, but they've been there, been at premise for maybe 5 years plus. So the tenant's been there 5 years plus. Now, what does the difference of this mean to you? Is that instead of getting, your 150,000 at 15,000, you're getting your 7% of 150,000, which is 10,500. That's your net rent. Now, your loan doesn't change. So your loan at 100K at 4% is still 4K. So now you're at 6,500. So it means that your positive cash flow has changed. Instead of getting 11,000, you're now getting 6,500. But what you find is that it's lower risk, which equals to lower yield, easier to retenant, and you may find that you've got a larger tenant pool who will want that property. So when it comes up for rental, and I guess the downside of something like this is that you've got the short lease period, as opposed to something if it was in a larger regional area, you might have a tenant on longer leases as well. And so that's the real difference. So you've got to ask yourself then, is that really the equation comes to, do you want 11,000 in positive cash flow versus 6,500 positive cash flow? Which one is more important to you? That's a question, and that's a question you have to answer, because the risk level is fundamentally different. So this one is higher yield, higher risk. This one is lower yield, lower risk. So which one is for you? That is something you've got to look at your own portfolio. So if your portfolio has, if your current portfolio has resi, which already has a growth component in there, and you are chasing pure cash flow, then this property might be right for you, as long as you understand the risk. If your portfolio has no properties, so you don't own any properties at all, you might have some shares, you have a deposit, and you're looking to buy, another property afterwards, you're looking for some growth, so some growth needed, then this property here will be much better off for you in the long run. So where you choose your cash flow position really depends on where you're sitting in terms of your portfolio. If you have got nothing to start with and you want something that's balanced and you can't really afford to sustain the property if you lose the tenant, then the lower yield, lower risk one is a much better option. If you've got some resi, you've got some growth in your portfolio, and you're really looking for pure cash flow to maybe plug your negative gearing holes, or plug in to really kick your portfolio along to bring you back to neutral, then something with a high yield, high risk is going to be much better, because ultimately it's all going to come down to your servicing and being able to do the next year. So that's really how the comparison works. And so therefore, I hope this has helped you to understand that, what is it that you need to look for when you have something little to start with. So if you had $50,000, so 50,000 in deposit, what are your options? So option one is you buy. So option one is you buy regional, rural, and you're looking for high yield, and you know it's high risk. Number 2, you buy closer to metro. That's going to be lower yield and lower risk. Number 3, you combine and do JVs with others. So you bulk up your 50,000 to 100K to 150K, or you buy units in a fund or a group deal. And there are many, many of those around in the market. So you can find them on meetups, you can find them on websites, funds and group deals. They provide, they can provide a bit of uplift, and sometimes the units start as little as $10,000, $25,000, and it gives you access to a range of commercial properties, and it's more set and forget. So these are really your 4 choices if you have $50,000 to start with in commercial property. So I hope that's been really helpful to you to understand, your options, what you can buy, and what the type of properties are. So I'm just going to quickly show you what those properties will be. So I'll just show you some photos of the properties so that you understand the likelihood of buying something like that for $50,000. Now, just because you're in the $150,000 to $170,000 range shouldn't stop you from starting a commercial property. It shouldn't definitely stop you from actually buying a commercial property, because at the end of the day, it's all actually about getting that cash flow and your foot in the door, and that stepping stone to the next property and the next property that follows. So important thing is to get the momentum and keep going. And then from there, it's to really build out that portfolio. Just to remember, there's always a variety, there's always a way into commercial property. If you need a hand, need some guidance, contact us at helentarrant.com. In the meantime, hit the bell, hit subscribe, and I'll see you at the next episode. Bye for now.